What is going on, investors? Hopefully you guys are doing well out there. Time to take a ride on the fintech side. We are going to take a look at 4 different fintech stock, mainly on the speculative side. We'll take a look at Block, otherwise known as Square, ticker symbol SQ. First time here on the channel, we'll take a look at LendingClub Corporation, ticker symbol LC. Although if you go back and look at, I think my very first video on this channel was on LendingClub. I have a lot of experience with the product and the company as well. We'll talk about that company. We'll talk about Coinbase, ticker symbol Coin. Over the last year, that stock's down big, down 60%. We'll have to talk about that one. And then we'll also talk about Affirm. That one also down about 60%. The one stock that I tend to include in these videos is SoFi, but I do a regularly quarter video on SoFi. So if you want information on that, you can search the channel for SoFi. The information really hasn't changed since they reported their earnings. Let's kick the video off with Block. Year to date, the stock's caught a bid, up 25% over the last year. Actually held up relatively nicely, down just 17%. When we look at the most recent earnings report, which came out on February 23rd, revenue came in at $4.65 billion. That was 14% growth year over year. Now, most of you understand that a lot of that revenue for this company actually comes from just kind of a very low margin Bitcoin. So I actually like that they stripped that out here. So excluding the Bitcoin revenue, the kind of what I would refer to kind of as the core business of Block came in at $2.82 billion. That was up 33% year over year. So I tell you what, that's a great metric. And when we get into these financials, that's the profit driver of this company. And if that can continue to grow 33% year over year, look, we still got a $48 billion valuation. We've still got a forward PE in the 40s. We'll resolve that as we keep moving through the analysis here. But things aren't looking too bad from at least from the core business side. When you look at the overall revenue perspective, you know, we're kind of a mid-teens grower out essentially into infinity, according to Wall Street. From the earnings side, you know, we're adjusting our way to some profits. We'll talk about that as we move through these financials. Now, I'm going to give you a year-end view because Block really didn't give me anything other than a year-end view. So that's kind of what we got to work with. And it's okay because looking at the company from a year-end perspective is probably what we would have done anyways. Now, far left-hand column is the most recent year. We had that $17.5 billion worth of revenue this year. It's actually down year over year, $17.6 billion last year. Now, most of that is actually due to your Bitcoin revenue. It was obviously a lot more popular last year in 2021 than it was this past year in 2022. You went from $10 billion in Bitcoin revenue down to $7.1 billion. Wouldn't really be concerned about that because your transaction-based revenue went from 4.7 to 5.7. Your subscription business, this is the highest margin business on the company, went from 2.7 up to nearly $4.6 billion. So I'm very excited about that because here's your subscription cost of that revenue. Just $861 million to produce this $4.5 billion. Hello, juicy margins right there. Your transaction revenue, you spent $3.4 billion to make this 5.7. And finally, your Bitcoin revenue, which we've discussed numerous times here on the channel, you spent nearly $7 billion to make $7.1 billion. So it's really just kind of a loss leader business, although they don't really lose money on them. But think about it as like that Costco hot dog. You're not going to build a solid business just kind of trading crypto back and forth. It's a nice add-on service. It's something that the Cash App users like, but it's not generating huge amounts of profits, especially when we consider, again, the company's worth $48 billion. $200 million is more or less a rounding error when you're talking about a company this size. Now, unfortunately, this is a Jack Dorsey-led company, and our total cost of revenue came in at $11.5 billion, and our net revenues came in at 17.5. So that gave us a strong gross profit, okay? $6 billion. Okay, this is a fintech company, not a software company. So those are very, very strong gross profits for this type of business. Now, again, unfortunately, Jack Dorsey is the CEO. Your product development costs went from 1.4 up to 2.1. Your sales and marketing went from 1.6 to over 2. Your general administrative went from under $1 billion to nearly $1.7 billion. They had to set aside more for transaction and loan losses. That's fine as your business grows, and in the current environment that we're in, you're pretty much expecting this. That went from 187 to 550. They took some impairment losses on Bitcoin, and then they finally have some amortization. You factor in all of those costs, and you're at $6.6 billion worth of cost. So yeah, you guessed it. You take about $6 billion in gross profit and you minus off $6.6 billion and you got an operating loss of $624 million. Last year, you made $161 million. Now, some of you are going to say these transaction and loan losses, this is likely a non-cash charge at the current time. So you could add those back in. You could add back in your Bitcoin impairment losses. Probably shouldn't do that, but your amortization of 138, you probably could add that back in. But Jack Dorsey essentially runs like break-even companies. You look at the financial history of Twitter, it was like a nonprofit, essentially, run for the employees as they drank lattes and had avocado toast. The executives got mega rich, and shareholders basically got out of the stock for about what it IPO'd at. And so, you know, that's the worry with this company, is they're not generating large amounts of profits to the bottom line. The office and the lifestyle of the employee is going to be fantastic, and the shareholder is not going to be taken care of very well at a company like this. They're not going to buy back the stock. They're not going to pay a dividend. They're not going to cut cost aggressively like you see maybe across other companies. Now, they have plenty of cash. Why would they? Investors are still bidding up the stock to the tune of over $40 billion. So why are they going to, listen to shareholders? They're already got some of them in their pocket. You got plenty of cash over here, balanced off by about $4 billion worth of debt. Nothing to be overly concerned about, because when you come down here to the statement of cash flows, it paints a pretty good story. Okay, you pull down a net income number this year of 553 negative, so you lost $553 million. Last year it was positive. The year before it was positive, but guess what? We have stock-based compensation. Jack Dorsey is getting rich over here, guys. $1 billion in stock-based compensation this year, folks. $1 billion in stock-based compensation. Last year was $608 million. The year before it was $397. Wouldn't you just love to be an executive at this company? You go from $397 to $608 to over $1 billion in stock-based compensation. When you get to add that back in dollar for dollar on cash flows, well, yeah, it's gonna turn a $553 million loss into a positive, okay? To positive cash flows of $175 million. Last year was much better at 847. The year before, it was about the same at 173. When you look at the rest of this company, it's light from the investing activity side and light from the financing activity side. Overall, considering they're able to pay the executives and a lot of the employees with stock, there's nothing really to worry about from a cash perspective. But when you look at the history of this company, yes, if you had bought these shares before 2018, which I would guess out of maybe a few thousand people that end up viewing this video, maybe one or two of you bought before 2018, you would have a profit in the stock. Everybody else that has bought the stock either has no profit, or basically if they sold, they would have no profit because they would have pay capital gains tax and factoring in any length of time or short-term capital gains, and you basically made nothing on the stock. The vast majority of the people have acquired the shares above $80 per share, and some people over $100, maybe even over $200 per share. So what it's going to take for this stock to get back to those levels or maybe start to rebound, one thing would be for Jack Dorsey to run a little bit more shareholder-friendly company, generate a little bit more positive cash flows without having to rely on stock-based compensation, generate higher amounts of operating income because they have the gross margins and they have the revenue growth to do it. They just don't do it over at this company. They just continue to reward. Look, if you work at this company, it's great. If you're an investor, it's been a disaster. We are at a critical level from a technical perspective. I've got a purple line in here. That has consistently been over the last several years. We'll just call it the $85 price range on the stock, 80 to 85. You've hit your head numerous times on that. And then if you are able to get above that area, well, I tell you what, it can trigger a massive rally. So that's what we're looking for with Block over the next couple of days. Can you get above 85 meaningfully? You are creating a beautiful series of higher lows here that is being confirmed by a series of higher highs. I mean, we're talking about like the micro trend here. That micro trend continues. And then, yeah, you can push back up into the 90s on this one. I could see some kind of momentum play. Anybody that's looking to capture some kind of profits in this one, anyone that's in this for the shorter term, these are the areas where you start to look to sell. Higher probability is this area in the mid 80s, you get rejected and you pull back down to a lower area areas where I would actually be interested in buying the stock is, we'll call it south of about $60. Anytime this stock over the last several years has gotten south of $60, buyers have stepped in and it has rebounded. But a lot of investors, including myself, just are simply not going to be interested in this company simply because any progress on the revenue growth side, any progress on the gross margin almost always gets chewed up with the operating expenses. And until this company can consistently do it, maybe 2, 3, 4 quarters in a row, or I'm convinced Jack Dorsey has turned the corner and he actually cares about shareholders, this is a great company. They have a great business. Their core business is growing in the 30 percentile. It's fantastic. I really actually like this company. I'd love to be an investor in it, but until these financials turn around, I'll be on the sidelines. If you want to take that ride and take that risk, there's probably certainly some reward here, and I wish you luck if you decide to go on the Jack Dorsey ride. Moving over to LendingClub Corporation over the last year, this one's down 38%. You look at over the last 5 years, this thing's down 53%. I talked about how some of my earliest videos on my channel is actually a LendingClub video. I actually was in on the IPO as I was a customer of LendingClub. I had an account there, and they rewarded the initial people that had accounts there with, I think it was like 150 or 200 shares right at the IPO, and we got it for the IPO price, not the actual opening price. So I made like $400 or $500 in one day on this stock. So I have some rosy feelings about this one, but I have not been in this stock in a long time. And I think you'll see some of the reasons why. Revenue coming in at $262 million. This company reported their earnings back on January 25th. That was just flat growth year over year, although it beat expectations a little bit. When we start to look out for subsequent quarters with LendingClub, it's going through a little bit of a rough patch, okay? Basically going through negative revenue growth for the next several quarters, and then Wall Street somehow has this pegged to reaccelerate to a 30% grower. I tell you what, if this is true, well, the stock is actually probably a buy. I don't know the rationale that is going to make calendar year 2024. Maybe it's you get these loans rolled over, they can charge a higher fee, because what we're seeing with LendingClub is it's a two-sided platform, okay? Like a lot of institutions, you're investing in the lender, whereas with LendingClub, you're actually investing in kind of the customer and the lender at the same time. As the Federal Reserve has aggressively raised interest rates, in some cases, you're thinking, well, that's good for LendingClub. They're going to be able to raise the rates, interest rates on the loans that they provide and those types of things. Well, yeah. Well, in some cases, though, it reduces the demand because as interest rates go higher, that's the reason why they're raising the interest rates over at the Federal Reserve. They want less and less people to borrow money. So there'll be less demand for a loan at a higher interest rate. The other thing that it does is it makes LendingClub less attractive. The reason why I opened up a lending account, I mean, we're talking many years ago, not to borrow money, but to actually invest money in the platform, was interest rates were at zero and I couldn't earn any money on that interest. And so you could actually open up a lending account and earn 7, 8, 9% interest pretty comfortably if you knew what you were doing. Now with interest rates where they're at, I can find a money market account or some kind of just very safe investment, earn 4, 5, 6, maybe even 7% on my money. So it actually makes LendingClub less attractive from an investing perspective. So it's a tough business because they actually have to attract the money and the customers. And I believe actually in a lower interest rate environment, this company probably would do a little bit better. We'll close that. We'll get to the most recent earnings report, which ended December 31st. So we had our total net revenues coming in at $262 million. They make money a number of different ways. They have kind of some origination fees. They have servicing fees. They have gains. Sometimes they sell off the loans kind of in packaging. They earn interest and a spread on that, similar to a normal bank or a traditional bank, if you will. And so you have kind of non-interest income, and then you have interest income. And the interest income over the last year, you can see, is up big time because as interest rates go up, well, that interest income continues to go up. But unfortunately, it's kind of offsetting the non-interest income. You see year over year, you're up 63% on that interest income, as again, over the last year, interest rates have just literally skyrocketed. Now, the non-interest income, though, that is down 30%. So it kind of offsets itself. The other thing that we're having to do in this environment is we're having to set aside more and more money for provision for credit losses. You see over the last year, that is up 36% because this company takes direct credit risk on the loans that it lends out. When those people don't pay back those loans, the company is responsible for that. So we're seeing those continue to tick up quarter over quarter. Now, fortunately, we also have non-interest expense over here, your compensation, your marketing, your salaries, all those types of things. They've actually done a nice job over at LendingClub, actually keeping those flat, if not down a couple percentage points. So you take your total net revenues in a quarter at 262, you peel off about 62 million of that, you're left with about $200 million. You peel off about $180 million worth of employee and marketing costs and those types of things, and you're left with net income over this company about $24 million. Now, unfortunately, that is down sequentially quarter over quarter. It's down year over year as well. But the company is profitable and it's solid, okay? And you don't got a wild valuation, okay? We got like $1 billion valuation on this one, which is essentially more or less kind of like one-time sales on this one. So it's not bad. The problem is what do you get as a shareholder? You're not getting a dividend because every dollar I put into LendingClub, I could go put in JP Morgan or Bank of America or even Wells Fargo these days and get a growing dividend. And then also in most of those cases, a growing buyback as well. So the company needs to do something, in my opinion, from a shareholder perspective to draw more interest, because when your stock slips under $10 per share, there is a problem. And then when we look at this from a technical perspective, it's really just been channeling down since the IPO. Yes, you had a moment of euphoria where a lot of speculative investors came in here and bought this shares up for some reason, but the story of LendingClub is kind of played out on Wall Street. And until it breaks out and over this channel, you have to assume that this channel is in place. If you get towards the bottom of the channel and then you start to see evidence of a reversal, you could play that move if you want. You could also short it from the top of the channel down to the bottom of the channel. Considering the stock is $9, I don't know how liquid the options market is. I'm assuming not that liquid considering the overall shares don't have huge volume, but sometimes these low dollar stocks tend to be popular with options trader because the option premiums tend to be a little bit lower. But I tell you what, if you retest the lows that you made back here in December, still wouldn't be excited. It's really this cluster back here, kind of those March lows that we made back in 2020. You get south of, we'll call it $5 on this one. I could certainly see taking a speculative flyer on this one because at that point you're pricing in almost all bad news. I would have a stop loss at this one set underneath those lows at about $4.37. Wouldn't want it to get below that. But as with LendingClub, as with all of the stocks on today's video, if I could eke out any amount of profit, I am doing that. These financials are not supportive of a long-term investment. There's no dividend, there's no buyback, and there's nothing here that investors can get wildly excited about. Let's see if we can get excited about Coinbase again. Initially, this stock was actually looking pretty darn good. That is because crypto was on fire, but as most of you know, and I'll show you evidence of here, I tell you what, people have lost all interest in crypto and they've lost most of their interest in Coinbase stock. Is over the last year, stock's down 61%, but year to date, hello. This is why these stocks are exciting. If you have good timing and good discipline, okay, I think actually the discipline's more important than the timing because look, you didn't have to capture the entire 86% gain that this stock has made since the beginning of the year. You just had to have the discipline to get in and then make sure you lock in some profits as well, because this one will probably reverse at some point. Although revenue came in the most recent quarter at $629 million. That was a 74% decline year over year, and it's just a disaster. When you look at the company's upcoming earnings estimates, you're looking at a 43% decline down to a 15% decline, and Wall Street's just guessing, folks, for Q3, Q4, and into next year. They're guessing that they're going to be able to re-accelerate their revenues. It's obviously a large predicated on Bitcoin and crypto kind of getting back in favor, because what we've seen, assets on the platform over at Coinbase, it's just gone. And why wouldn't it? Okay, you look at the FTX situation, you look at kind of the shaky footing Binance seems to be on, and look, it goes back to like Mt. Gox and all these exchange, like literally like every decent exchange over the years, they've ran away with the money, okay, from FTX to Mt. Gox to probably Binance at some point as well. And so consumers and the institutionals, they don't want to be left holding an empty bag, okay? Now, Coinbase is regulated. The odds of them just straight running away with the money like Sam Bankman-Fried, probably, I don't want to say it's a non-zero chance, but it's a little bit less than what you had in that FTX situation. But look at this. Consumers pulled the assets off the platform. Last year, they had $141 billion, now just $40 billion. Institutionals did the same thing, $137 billion last year, all the way down to 40. So they're just pulling the assets off, and without the assets on the platform, an exchange just simply cannot, make enough money. Coinbase is going to have to right size this business, because look at last year. You had $2.5 billion worth of revenue. Okay, and that's for like a quarter. We're not talking about a year. We're talking about in one quarter, this company had $2.5 billion in revenue. That shrunk all the way to $629 million. Now, we still have a $15 billion valuation on this one, but it's starting to right size a little bit. Now, the problem is they haven't reacted fast enough with these operating expenses. Look at this. You went from we'll call that $1.6 billion. Look, last year, this stock was fantastic, okay? And there's a reason why. Last year, this stock was 61% higher because, look, off of $2.5 billion worth of revenue, they had $1.5 billion in costs. They made nearly $1 billion in a quarter. Now it's almost the opposite. Off of $629 in revenue, you have $1.2 billion in cost. That gives you an operating loss of $554 million. I mean, it's a disaster. It's a disaster. Look for the full year. Last year, you made $3 billion in operating income. Oh my goodness, that's juicy. It literally reversed almost 180 degrees to almost 360 degrees down to $2.7 billion loss. So last year, you made $3 billion. This year, you lost $2.7 billion. So there's some opportunity here. If you believe that crypto is going to come back, a lot of the competition has just been wiped out with FTX. And if you believe this company, it's really kind of a marketing, kind of get the confidence back of the consumer and the institution. Well, if you think Coinbase is going to be doing that, there's like no competition for this stock. Now, when you come down here to cash flows, it's a little weird analyzing this company from a cash flow perspective based on how they have to do these accounting rules. But look, they don't have a lot of investments. They don't have a lot of things to do. And look, from a cash perspective, they have plenty of cash, $4.4 billion. It's balanced off with almost an equal amount of debt. But this company can survive for a little while doing this, but there is some risk here. There is not necessarily some risk they just run off with customer funds, but there is some dilution risk. There absolutely is dilution risk. There's risk that this company is going to have to do some kind of fundraising if crypto just simply does not come back in style. Now, over the past several months or so, we'll call it close to a year or so, the stock's actually traded in, I wouldn't say a tight range, but it's been a relatively tight range from about 50 up to, we'll call it about $80 per share. It's currently sitting like in the middle of this. That just tells me Wall Street's kind of on both sides of this. You have some people that do believe that crypto, and in this case, the competition has kind of wiped itself out. And so this company is well positioned. If you can get popularity in crypto, you can get the assets back on the platforms, you get people to start trading these things. There is some opportunity here. But until that materializes or you have your real finger on the pulse there, my guess is you're trading in this range. And again, like with all of these stocks, if you buy this stock at 60 and it goes up here to the top of the range at 80, I would at the very least peel off some profits, and then I would absolutely have a stop loss. If I bought it here at 60, I'll tell you what, I'd probably have a stop loss at 55 because I wouldn't want to be caught on the downside of this one either. I tell you what, again, the entire trajectory of this company is down. I mean, this is as simple as it gets from a technical perspective. Nobody is holding this stock for a profit. Yeah, a couple of people bought it down here south of $40, but I tell you what, if they were to sell right now, they're paying like a 30% capital gains tax on that. So it's not like they're going to get rich off of that. They're going to make the federal government rich with short-term capital gains. There's nobody that's held this stock for any length of time that's actually profitable. That's why if you are going to get into these names, understand the risk, understand what's going on with the financials and the sector, and take profits if you possibly can. Not if you possibly can, when you possibly can. Now, moving on to Affirm. This ticker symbol is AFRM. This is an interesting business. Okay, you got a $4 billion business over here. You got a stock over the last year is down 60%. Year to date, though, hello, this is the reason why we're covering these stocks, okay? They can catch a wave, up 44%. Now, the company reported their earnings back on February 8. Revenue came in at $400 million on the dot. That was 10.8% growth year over year. They missed expectations by a little bit. Q3 was going to come in a little lighter than Q4, which you'd expect. Look, holiday shopping season, a lot of people borrowing money to buy gifts and look cool. Well, they're not going to do that necessarily in the upcoming quarter. That'd be 360 to 380. Consensus, though, is for a lot higher than that, up over $418 million. So sequentially, Wall Street was expecting to go from like 400 up to 418. Well, they didn't do that. And so that's a problem for the full year as well, which is really just the next two quarters, fiscal quarters for Affirm. You're expected right about $1.5 billion worth of revenue. Well, Wall Street was expecting 1.64. So the company's missing the mark a little bit. And what are they going to do? They are going to cut about 19% of the jobs. You actually like to see this. The speed in which they're doing that, you actually like to see this. And when we come over here to this financials, here's at $400 million worth of revenue. They, multiple different revenue streams, but all things being considered, it's 400. Last year, you were at 361. You see it on the 6-month basis. They're on a funky kind of fiscal quarterly system, went from 630 up to 760. So not explosive growth, but look, the explosive valuation has been peeled off of this one a little bit. If you want to annualize out the 761, you're at $1.5 billion worth of revenue in a $4 billion company. It's not cheap, okay, but it's not wildly overvalued. Now, the problem with this company is off of $399 million worth of revenue, we have operating expenses coming in at $759 million. Yeah, folks, our operating expenses are almost double our revenue, and it's not getting any better. Notice last year we were at 361 revenue and we had $557 million. So last year we lost $196 million. This year we lost $360 million. Look at it for the last 6 months. You went from 362 to 646. The short interest got to be sky high. Yep, 19%. So anytime you see this short interest, some people get mad and they get mad at these short sellers and stuff. Guys, this is all the short sellers are looking at. What we're looking at, the short sellers don't have any inside information. They literally pull this up and they say, $399 million in revenue, $759 million in operating costs. This is a pretty bad business. This would be like a lemonade stand selling lemonade for $1 and their cost being $5 a cup. It's just not a good business. And so the short sellers just is betting that this company is not going to be able to turn around, or they're betting that, they're probably not going to turn it around and they're going to have to dilute the heck out of you because they're probably going to have to raise some money. I'm going to zoom up to a balance sheet. Speaking of money, the company isn't loaded, okay? So you got about, we'll call that just $2 billion in cash. Total current assets coming in at $3.4 billion. Some of that includes some loans held for investment, which can be written off. Luckily, there's not a ton of liabilities, so they could leverage that at some point, but obviously that's not going to be shareholder friendly if they have to leverage up the debt or leverage up the equity and these types of things. Come down here to a cash flow statement. With these companies that loan money, cash flows don't always line up. What you'd want to make sure is that these loans held for sale and the proceeds of the loans, if these two numbers basically cancel each other out, which they do in this case, I think you can pull from cash flows. Now, the company is going to have rather hefty stock-based compensation to the tune of $241 million. Last year was at $181. So we take a $573 million net loss, and the net cash bled through the company is just $22 million. And so you see over the last 6 months or so, the company's actually not burned through a lot of physical cash, and so that is a good thing to a certain degree. Again, short sellers are going to believe that that is not going to continue, because what's going to happen in subsequent quarters, as they're starting to miss some revenue guidance here and the revenue is starting to slip, they're going to bet that these operating expenses, they're not going to be able to cut these fast enough. And so you're just going to continue to bleed money over at this company, at least from an operating perspective. Now, From a technical perspective, it doesn't get any more simple than this. Nobody, literally nobody has made money buying this stock. So just understand that. Always, whenever you buy a stock, always bring up the price. Okay, look, if you go buy a car, if you go buy a house, if you go buy anything, an iPhone, whatever, typically one of the first things you look at is the price. And some people are like, I don't do technical analysis. It's like, no, all you're doing is looking at the price when you're doing technical analysis, okay? Yeah, you could draw fancy lines. You could have fancy moving averages and all these little lines and charts and all this stuff on here. But really, all this is a price chart. And you see here, the price of the shares have simply never appreciated. Yeah, in the shorter term, there's been some pops, but it's always followed by an even larger drop. Right now, I mean, this channel actually goes back to the IPO day. The stock has not been able to get out of this channel. Yeah, briefly during the pandemic hype and everybody had margin in a Robinhood account, yeah, it popped out. But ever since then, it's been going down. More than likely, this one's headed back down to the bottom of the channel. This, in my opinion, is probably more or less a short candidate. That's why you have a rather strong short interest in this stock, because from a fundamental perspective and a technical perspective, this one just has lower. If you do decide to short this one or play at that side, don't get overly greedy, because there certainly could be a press release. There could be something that pops this stock up, even like a buyout or an acquisition. This company could certainly be an acquisition target at some point, but this one looks like to me poised to kind of stall out at the top of the range, go back and retest these lows that we made back in January, south of $10 per share. Again, I would be trailing out of any kind of short position. Just like the long position, if you decide to take a long position in this, I would instantly take profits. I would also do it from the short side as well, because again, at a $4 billion valuation, if that continues to be walked back, I could see this being an acquisition target from somebody, either a larger financial institution or somebody that wants to roll up in this space. Hopefully you guys enjoyed today's very speculative fintechs. Hopefully you learned something as we go through these financials. This is certainly not Google, Microsoft, and Apple, but we can learn something every time we look at these things. And certainly from a shorter term perspective, if you have the discipline and you have the timing, there's some money to be made in these types of names. Hopefully you guys enjoyed today's video. We'll be back again soon with more. Good luck with your investments.